Where did $1.4 billion of Tesla assets go? As Tesla's vehicle sales and stock price decline, partly due to Elon Musk's political and personal actions, an unusual discrepancy has surfaced in the company's financial records. Comparing Tesla's capital expenditures in the last 6 months of 2024 to the valuation of the assets acquired, there appears to be a $1.4 billion shortfall. This amount is significant even for Tesla, especially as scrutiny returns to the company's financials following a drop in its fully diluted market value from $1.7 trillion to below $800 billion. A deeper look at Tesla's cash flow statements raises further questions, such as why a company with $37 billion in cash reserves borrowed an additional $6 billion last year. Tesla has been making large investments, particularly in AI infrastructure, planning to spend at least $11 billion annually on robotics, computing, and battery technologies. In the latter half of 2024, its cash flow statements indicate $6.3 billion spent on acquiring property and equipment, excluding finance leases, net of sales. However, the gross value of Tesla's property, plant, and equipment increased by only $4.9 billion during the same period, creating a discrepancy. Normally, these figures should align. For instance, General Motors invested $30 billion in capital expenditures over 3 years, sold $14 billion worth of assets, and recorded a net increase of $16 billion in the gross value of its property and equipment. Luzi Hail, an accounting professor at Wharton, explained that such discrepancies arise because financial statements reflect net changes rather than detailed transactions. Factors such as asset sales, mergers and acquisitions, or currency fluctuations could impact these numbers. However, Tesla does report both gross figures and accumulated depreciation, and it has not disclosed any major asset sales or impairments that would account for the missing $1.4 billion. Furthermore, currency fluctuations seem unlikely to explain the gap, as most of Tesla's assets are based in the US. This discrepancy is unusual for Tesla itself. Historically, changes in the gross value of property and equipment have generally matched capital expenditures, except in 2021, when there was a $1.3 billion increase. The scale of the current anomaly is unprecedented. Such inconsistencies can raise concerns about weak internal controls, or even potential misclassification of expenses to inflate reported profits. Tesla has not responded to inquiries regarding the issue. It remains possible that the missing assets will appear in future financial reports, or that Tesla's recent political endorsements could boost sales. Some potential customers may also be waiting for the updated Model Y. If these factors do not materialize, questions about how Tesla is managing its cash and where its funds are held could become more pressing. In 2024, Tesla generated $15 billion in operating cash flow, invested $11 billion in its business, and did not issue dividends or repurchase shares. Despite this, the company raised an additional $3.9 billion in financing, following $2.6 billion in 2023. Such a pattern, generating strong cash flows while simultaneously raising capital, can sometimes indicate accounting irregularities. Jacek Velk, a corporate finance professor at SRH Berlin University of Applied Sciences, has studied 17 cases where seemingly profitable companies required continuous external financing, including Wirecard, Longtop Financial Technologies, and NMC Health. Tesla, however, could simply be optimizing its balance sheet in preparation for further investments. The company also faces short-term cash management challenges, as rising inventory absorbed $1.5 billion in cash in early 2024. Additionally, issues like car theft and dealership protests may further impact its financial situation this year.